All right, good evening, everyone. Again, my name is Jason Mate. I'm going to be your presenter for this evening. So thanks so much for joining us for our Arizona Homebuyer Workshop. This is our third workshop that we got a chance to do for the University of Arizona alumni. So we're really excited to bring this content to you. Like I mentioned earlier, we really try to make this an interactive session. So as we move through tonight's presentation, feel free to chime in with any questions you have, and we'll do our best to answer those on the air. And we always wrap up our discussions during the workshops with just an open Q&A too. So we'll get a chance to review that as well. So let's go ahead and dive in as I move through tonight's slides. Just a quick little bit about me. So I'm the branch manager for American Pacific Mortgage and do all our presentations within our different partnerships. We're based out of Sacramento, California, but we service nationwide, specifically for our partnerships. We're obviously in California, Arizona, and most of our West Coast states, but we're a nationwide company. And we really specialize in first-time homebuyer programs, which you're going to hear a little bit of this evening. Tonight's talking points, we're going to talk a little bit about the housing market, what it looks like today. Lots going on in the housing market, whether in Arizona or California. There's a lot to talk about. And then after we kind of get our market update, we're going to move into just some things around buying. Does buying make sense? Look at some budgeting and kind of get things figured out from that perspective. We're also going to look at credit, talk a little bit about credit, give you some resources and support around that. And which will include some quick information on student loans. We'll look at loan programs. What does qualifying income look like? Kind of more of the documentation that you'll need for the home buying process. And then we'll spend some time looking at down payment assistance programs to help you kind of get some support and resources around down payment and closing costs. And then we'll wrap up tonight's discussion looking at what the process looks like for the home buying. We have 6 steps of home buying that we'll kind of walk you through so you can get a good idea, a good visual of what it looks like to go from pre-approval all the way up to getting the keys to the home of your dreams. And we'll talk a little bit about a personal consultation, what that kind of looks like, because that'll kind of set up the framework for like a game plan for you with home buying. Okay, so that's what we're going to review this evening. Again, feel free to reach out to us if you do have questions as we're going through tonight's content. So let's talk a little bit about the housing market and kind of where we're at. And you can see kind of as from 2006 all the way up to 2021, huge increase in the average home price, right? So, and that does change by market. The one big question we get, especially right now with home prices being so high, is, do we have a bubble forthcoming here? And when you look at the inventory levels, the demand, and where interest rates are at, we just don't see a bubble. Now, we could see a little bit of a slowdown in the market, but we don't forecast any type of bubble coming, especially when we look at the qualifying criteria for buyers. It's just much more stringent. Back in 2006, there was a lot of lenders that were doing undocumented loans, buyers that maybe didn't have quite the credit scores to be in a position to qualify for certain mortgages. So things have changed a lot. Most loans today are fully documented. In fact, that's all the loans that we do are fully documented, where buyers are verifying income, assets, all that. And so it's just a different type of market now. So, and really we can't build enough homes. So we're really looking for, hopefully for new construction, especially some of our areas like Arizona and California, to help fuel some of the housing market. But nonetheless, you can see the huge jump in average home price across the nation. And then when you look at interest rates are going from 6% down to, average about 3%. Those change day by day. In fact, we're going to talk a little bit about interest rates here in just a bit. And then, of course, the median income has increased over those last 15 years. So a little bit different of a situation when it comes to the housing market. So now let's kind of look at, as we're preparing to buy, let's look at, does buying make sense? And, this is probably going to be one of the biggest assets that you purchase in your lifetime. And so, for all of us that are taking the time to join this workshop and kind of figure home buying out, hats off to you guys, because really you want to make that educational investment to make sure you're making a good, smart purchase. And when we think about the benefits of buying a house, it creates a few things, stability in your housing budget. It is an asset, so you have the ability to be able to pass along this asset to the heirs of your estate. And as your home grows in equity, obviously you can see in our last slide, as home prices go up, the difference between what you owe versus what it's worth creates that equity. And so huge opportunity there for you as well as an owner. And this does create potential tax benefits. Now, even though we've had some tax changes over the last few years, you can still have the ability to potentially deduct interest on your mortgage. Of course, you want to talk to a tax advisor about that, but lots of great things that come with benefits of owning a home. So one of the things I want to walk us through in tonight's discussion is a rent versus buying calculator. And I'm going to kind of switch screens here so I can kind of take you through what it looks like as we're doing some kind of budgeting for our upcoming home purchase. We okay on my screen? Okay. So let's kind of take a peek at this, this calculator. By the way, all the tools that we share with you this evening, we're going to go ahead and email those to you tomorrow morning as a follow-up to tonight's workshop. So let's do some analysis here. So we're going to plug in a current situation. If we were to rent, let's say we had monthly rent of about $2,000 a month. And then of course, with monthly renter's insurance, let's say it's about $20 a month. So that my outgoing right now expenditures as a renter is about $20 a month. Now, if we assume my rent price is going to go up about 3% year over year. So every time I renew my lease is going, or my rent's going up by 3%. We're going to factor that into our budget. So this calculator will kind of set a timeline for you in terms of like when you plan on selling your house. So it's going to be do a side-by-side of renting versus buying, right? This analysis that we're going to take you through right now just assumes that you're going to be in the new house 7 years, and it'll compare that versus renting for the next 7 years. So let's say if we bought a house, we're going to say $350 as a purchase price. Now, depending on where you're joining us from, if you're in Arizona or maybe you're in California, obviously those prices will be a little bit different. But let's say we purchased at $350. The minimum down payment is 3%. Okay, which would be about $10,500. So let's look at property taxes. Property taxes will be about $4,000 annually. Homeowners insurance of $1,000 a year, and then maintenance on that home. We want to factor that into our budget as well, because when we own a home versus renting, we're not going to be able to contact the landlord to fix any type of issues we have. We have to make sure that we have that built into our expense budget. And then from a loan perspective, we're generally going to be doing a 30-year fixed mortgage. We're going to assume, just for this example here, a 3.25% rate. Of course, that can change depending on when we decide to purchase our home. Origination charges, those are what we call as closing costs, and those are generally part of the lender's charges. Now, good news is for our University of Arizona alumni, you get a discount that we offer with our financing. So you get $750 off of our closing costs, which will help decrease the total amount of money out of pocket. Discount points here, that's when you, in your structuring your financing, you can buy points to lower your interest rate. Generally, 1 point equals 1% of your loan amount. So in this example, we're looking at 1 point being right around $3,000 in order to bring down your rate. Now, that's not part of this scenario here, but as a buyer, you will have the option to do that in customizing your financing. And then other settlement charges are going to be part of your overall closing costs. Usually closing costs are about 2 to 3% of your sales price. Okay. And then the other assumptions we're going to make in this calculation is appreciation rate. We're going to assume 3% rate, and that's going to kind of span over 7 years. Obviously, you know, many existing homeowners have had 10, 12% appreciation year over year, but certainly we don't want to kind of factor that into our equation here when we're projecting out our own buying situation. Again, like I mentioned earlier, 7 years in the home. Now, the cost of selling a home is not, you don't really realize that cost until you sell the home. But as a buyer, when you purchase a home, a realtor that represents you, the commissions that realtor earns from the sale of the home, those aren't paid out, or those are paid out, I should say, by the seller. So as a buyer representing you, you don't have to pay commissions to a realtor. Those are always going to be paid for by the seller. Now, we also want to assume that the state and federal tax rate, depending on where you're looking at purchasing, the state tax rate will differ a bit. If you're joining us from California, as we know, here in California, taxes are a little bit higher. And then savings rate, 1%. So if we were to kind of do a side-by-side comparison, and let's say we continue to rent over the next 7 years, we're looking about paying about $178,000, over $778,000 in rent. Now, comparing that to the buy side would be about $90,000. But the reason why the buy side is lower is because we're factoring appreciation, tax benefits. They all come with home buying. And so what that looks like over 7 years is that I'm basically going to save about $88,000 by buying instead of renting over the next 7 years. Now, You could probably argue that maybe the rent's a little bit high. Maybe we could say, okay, rent's closer to 1,600. And if we did that, then our opportunity drops down to about 53,000. But nonetheless, clearly buying versus renting would be certainly on the buy side. Okay. Now, if you are not paying any rent right now and you're looking to purchase, then certainly that could look a lot different for you. But based upon average rents in the greater Phoenix area, 1,600 is probably a pretty reasonable number to use. Okay. Again, we're going to send you all this material here tomorrow morning with our presentation, so you can take a look at that. Okay, so I'm going to jump back into our slideshow. I think we should be good. Let's go ahead and talk a little bit about housing appreciation. So as we look across the last, let's go actually start, in this gray bar right here. That's really where we entered the pandemic. And as you can see, just a huge increase in purchase price, average appreciation from 2020 up until today. And we really haven't, stabilized quite yet from a value perspective. We're still seeing that line go up. Now, we are starting to see some changes when it comes to activity levels in the market. When first-time buyers consult with us, they say, they want to know what the competitiveness looks like in the market. And I think when we look back into the spring and summer buying months, we typically saw maybe 20 to 30 offers on a home. Now, the market has cooled down a little bit, some of it being seasonalities in the market because we're in the winter months, but we're still seeing probably 5 to 10 offers on certain properties. But why that's encouraging for first-time home buyers is now we don't have as much competition. So, and sellers are a little bit more flexible on what they're willing to negotiate. So good encouraging sign here. So if we can hopefully see this housing appreciation cool down a little bit because of inventory levels, maybe getting a little bit more inventory on the market, although that'll probably come in the spring and summer months. But if we can get that to stabilize a little bit, we should be in a better position for our first-time home buyers. Now let's look at interest rates, and let's take a look at interest rates going back into the early 90s. Now, average interest rate right now is fluctuating between 3 and 3.25. We've seen interest rates start to rally a little bit over the last 2 or 3 days. So hopefully we'll keep up that. We did see interest rates get as low as 2.625, as you can see here in our graph, right about in the early part of the fourth quarter of 2020. That was the lowest level that we've seen, 2.625. And then you can see kind of how interest rates, as we moved into 2021, started to bounce upwards. In fact, right about here was February of 2021. We saw rates tick up closer to 3.5 to 3.7. So I should say 3.5 to 3.625. And you can see then that interest rates started to cool off a little bit. They didn't quite reach the low levels that we saw in 2020, but nonetheless, they came down to about 2.7, 2.8. But then we've also seen them start to inch up a little bit. Now, what you're seeing on the down slide right here is kind of the activity as of recent. So we're hoping that rally continues, and hopefully we'll see rates getting closer to the low twos. Now, something that's going on in the market right now that as first-time homebuyers planning for the future, especially in the next year, the Federal Reserve is starting to pull back on what they call as mortgage-backed security purchasing. And right now they're purchasing somewhere in the neighborhood about $10 billion in mortgage-backed securities on a monthly basis. That is going to start to tick down a bit. And I think they're pulling it back to about $4 billion in purchases. And that's going to begin, I believe, this month. And so what's going to happen is as we move, or our thought is, but as we move into 2022, we're probably going to start to see rates inch up a bit. The forecast we're getting coming in somewhere in the around the 3.5 to 3.625 range. So we're definitely going to see higher interest rates in 2022. So for those of us joining this evening, if you're looking to buy next year, which we only have 2 months left, so in 2021, so you're probably going to be buying next year. So we want to kind of factor in a higher rate environment as we build our monthly budgets. Okay, so that was interest rates, and interest rates as lenders that are, well, the interest rate that's provided to you from lenders is not necessarily, it's not the same rate for all consumers, and credit has a lot to do with your availability for interest rate. Generally, the higher your credit score is, the lower your interest rate is going to be. So if you hit the 740 credit score level or higher, generally you're going to get the best rate offering from a lender. Let's take a look at credit and kind of how that influences you in the home buying process. So this is a FICO score calculation. So you can get a sense of what's built into the FICO model. So 15% of a FICO score is how long you've had credit. Okay, so the longer I've had credit, the better my credit score probably is. 20% is how long I've had credit in use or new credit. So more importantly, it's going to be around credit inquiries, hard inquiries. Now, when you start our process with us in consulting with us, we're going to start with a soft inquiry, which doesn't impact your score, but hard inquiries do. Eventually, we will need to do a hard inquiry, but initially, just to kind of figure out our home buying game plan, we start with a soft credit pull. Now, if you've activated or opened a lot of new accounts recently, that's also going to damage that aspect of your credit score. So up to 20%, or it's 20% of your score. And then 30% is how much you owe, also known as credit utilization. Okay, so when we look at our credit cards, credit utilization is going to be our credit limits versus our credit balances. So if I have $10,000 in credit limits and $5,000 in credit balances, I'm at 50% utilization. Ideally, if we're running, say, 70% utilization right now, we want to try to get that utilization below 50%. Okay, that would be our target goal. If you've already kind of kept your utilization below 50%, now you're trying to get an optimal score level, then you want to target below 10% utilization. So that's the goal. Now, one of the things I like to share with our attendees in our workshops is looking at how to optimize your credit score. Really comes down to some of your billing statement dates. So when you manage your credit cards and you pay those on a monthly basis, if you're paying off your cards on the due date, unfortunately, the balance that gets reported to the credit bureaus gets reported on your billing cycle date. So let me kind of back up for a second. So if I have a credit card with, let's say, a $10,000 limit and a $5,000 balance, but I pay off that $5,000 balance on the 4th of every month, which is my due date. The problem with that is that the credit agency or the credit issuer, let's say it's American Express, is sending out the credit data to the credit bureaus on the end of your billing cycle date. So if my billing cycle date's on the 25th, but I don't pay off my credit card until the 4th or 3rd, whatever it might be, the credit bureaus are showing me with a $5,000 balance, even though I pay that off. And so what that's doing is it could pull down my credit score a little bit, because now I'm showing 50% utilization where I'm thinking that it's maybe 0 utilization. So a good kind of rule of thumb is, if you're trying to really maximize credit score, is try to pay down or pay off your balances before the end of your billing cycle. Okay. And then the final component to the FICO score calculation is payment history, which is pretty self-explanatory. You obviously want to pay everything on time. Late payments are based upon 30, 60, and 90 plus delinquencies. If you've had a late challenge, let's say in the last 12 to 24 months, that's going to be the most impactful for your score. If you've had some past lates, as you get further and further away from that late, ideally beyond 24 months, you should see some kind of organic improvement in your credit score. Now, as I mentioned earlier, interest rates that are offered to you from lenders are going to be based upon your credit score, and product offerings are similarly set up that way as well. So the minimum credit score for an FHA loan is 600, which we're going to talk more about products in just a bit. Conventional loans at 620, and then for the Arizona Home Plus program, which we're going to spend some time talking about for assistance programs, that minimum credit score is a 640. Now, other things just to think about with regards to credit is account closure. So you want to be careful closing accounts, because what happens is if you close an account, your length of credit can be impacted. So if I've had an account since 2000, let's say that was my first credit card I ever got, and now I'm transferring the balance to another credit card company, and I'm opening up a new account, but I'm closing out the old account from 2000, then all of that great history I've had, that's really helping support me with my length of credit, gets pulled out of the credit model, including the on-time payment history. So you really want to be careful about closing out accounts in that situation. Okay. Now, from a lending perspective, and I'll just kind of talk about the last bullet point here, credit scores, when it's qualifying for a mortgage, we're always going to take the middle score for the borrower. Now, if you're applying jointly, we're going to take the lowest middle score between the two of you. Now, what does middle score mean? It's not average. It's taking the three bureaus, so Equifax, Experian, and TransUnion, whatever the second score is there. So if I have a 660, 680, and 700 credit score, I'm going to take the 680 to qualify. Now, if my spouse's middle score is a 700, for example, I'm still going to have to use the 680 credit score for qualifying for a mortgage. Okay. So just want to share with you just a little bit around potential challenges you've had on your credit. Now, credit inquiries may not necessarily be a challenge, but credit inquiries can impact your credit score. So those hard inquiries that you do will be on your credit for 2 years or less. One thing I forgot to mention on the previous slide, as it relates to hard inquiries, if you're applying for a mortgage or an auto loan, you do have a 30-day window of time to apply with as many lenders as you want in a 30-day window of time, and it's the equivalent of one credit inquiry hit to your score. Now, soft inquiries are obviously completely different, but that's the way inquiries work. Now, past challenges like late payments, collections, judgments, those will all be on your credit report for 7 years or less. If you've had a federal bankruptcy, Chapter 7, 10, even a 13, those can be on your credit report for 10 years. And then if you have any federal debt, like federal delinquent debt, student loans, maybe a tax liens, those can be on your credit report indefinitely. So we really want to take care of that stuff. Now, as lenders, when we qualify you for financing, we have to run a report that lets us know if any federal debt is delinquent. It's called the Cavers report. And so if you had any maybe student loans that are in collections or maybe unpaid taxes or anything like that, we do cross-check that in lending. So if you do have any of those things outstanding, try to resolve those as you get ready to take the next steps towards homeownership. Now, student loans are things that come up as part of our consultation, and we help kind of navigate our buyers through those and the calculations we use as lenders. And we're going to spend some time talking about products in just a bit, but there's kind of two different lenses that we have to put on the calculation for student loans. If we do a conventional loan, and let's say, assuming we have $100,000 in student loan debt, if you have an income-based repayment amount, now I do realize most of your student loans are probably in forbearance. If you do have them, they're in forbearance till January. But as a lender, we still have to count a monthly payment before you're qualifying. So let's say I have an income-based repayment amount of $250 per month. That $250 is what's going to be used to qualify you for your mortgage. Now, FHA loans, which is another product offering, there's a couple different routes we can go with that. If you are not on an income-based repayment amount, and maybe you're just let's say you're in grad school right now, and you don't have a monthly payment on those loans, we can apply 0.5% of the balance. So let's say $500 a month. That can be used towards your qualifying payment, or you can sign up for an IVR payment, but typically you wouldn't do that if you're in school. Now, there's going to be some monthly payment that has to be counted against you for qualifying. So like I said, whether you're back in school or you're on a deferment or forbearance, we just have to count a monthly payment for you with the financing. Okay. And then let's kind of transition a little bit. Let's look at loan programs. And I know I've kind of mentioned a little bit about the conventional loans and FHA loans as it relates to credit score and student loans. But I want to kind of spend some time talking about kind of the 5 core products when it comes to financing. And usually it's conventional loans, which is, you'll maybe hear that more around Fannie Mae and Freddie Mac loans. FHA, which by the way are not just for first-time buyers, they can also be for second-time, third-time buyers. VA loans, those are for our veterans that have served. That's 100% financing. And then USDA, the U.S. Department of Agriculture has a rural loan that allows buyers, whether first or second-time buyers, to purchase in maybe underdeveloped areas. That is a 0 down payment up to a loan amount of $625. And then jumbo loans are for any of our clients that are trying to purchase above $625,000. Now, jumbo loans do generally require a minimum down payment of $10,000 to $15,000. I'm sorry, 10% to 15% down. And so anytime we go beyond our financing over 625, we'll require the 10 to 15% down. Now, jumbo loans do have another component that's a little bit different than conventional loans and FHA loans, and that they do require reserves. And reserves are the amount of assets that you have left behind after you've contributed your down payment and your closing costs. Generally, those asset requirements are the equivalent of 6 to 12 months of your monthly payment Okay, so let's say, for example, I have a monthly payment of $4,000 a month, and my asset requirement for reserves is $48,000. That would be, I would have to show, or 12 months times 4,000 would be $48,000. I would have to have that in assets available just in reserve for my home purchase, above and beyond my down payment and my closing costs. Now, conventional loans require a minimum down payment of 3%. Now, you notice here the maximum loan amount is $625,000. That loan amount is kind of changing right now. That's the new conforming limit amount for 2022. We've already adopted that for our loan amounts. So there is areas that are called high balance loans or high cost of living areas. We don't have any of that in Arizona, but in California, if you guys are joining us from Southern California or the Bay Area or even the Sacramento area, those maximum loan limits will be a bit higher, but right now it's up to $625,000 in Arizona with 3% down. Now, conventional loans generally require a 620 credit score, and there's some other kind of aspects to conventional financing that we'll talk about in just a second. Now, FHA loans require 3.5% down payment, and it also follows the conventional loan limit. They'll go all the way up to $625,000. Okay. Some counties will differ a little bit. So if you are looking at utilizing FHA financing, we want to look at that specific county to make sure your loan amount will fall within the county limits for FHA. Now, when we compare conventional loans versus FHA loans, there is some credit score differences. Obviously, you heard earlier, conventional loans are 620 credit score, FHA loans are 600. But there is some differences around mortgage insurance, or also known as PMI. PMI comes into play when we put down less than 20% for our mortgage. Now, conventional loan mortgage insurance is a little bit different than FHA. So conventional loan mortgage insurance is based upon three different criteria. One is it's based upon your credit score. Secondly, it's based on how much you put down. And third is how much you finance. So the more you put down, the higher your credit score, the less you finance, the cheaper your mortgage insurance is going to be. FHA is a little bit different because FHA is going to have the same premium rate regardless of how much you put down. Although if you hit 10% down, it's a little bit lower. But for the most part, it's going to be a fixed amount regardless of how much you put down and regardless of your credit score. So whether I'm a 600 credit score or a 700 credit score, FHA mortgage insurance is going to be the same. Now, another big difference between conventional loans and FHA loans with mortgage insurance is there's a cancellation option with conventional loans. So generally when you have 2 years in the home and 22% equity, you can apply to have the mortgage insurance removed. With FHA, you do have to keep the mortgage insurance for the full term of the loan, so for 30 years. You can cancel it, of course, by refinancing, or if you sell your home, of course, then you'll pay off the loan. But there is no cancellation option like we do with conventional loans. So the question we get from home buyers as well, why would I choose FHA over conventional or vice versa? Well, it really depends on your qualifying. Obviously, there's a minimum credit score difference between both products, but FHA has a little more leniency when it comes to past challenges like bankruptcies, foreclosures, short sales, which is just a different time frame than conventional loans would offer. For example, if I've had a bankruptcy maybe 3 years ago, unfortunately, conventional requires a 4-year discharge date versus FHA is only 2 years. So there's a little subtle differences that may choose one product over the other. It's not just necessarily about credit score, but it's also about how we meet the guidelines required for that particular program. Okay, now we're going to spend some time in a little bit just looking specifically at how assistance programs align with the conventional FHA loan products as well. Okay, let's go ahead and move over to qualifying income and specifically some of the documentation required. So when we kind of step back for a second and look at home buying and our eligibility, there's a few kind of key things that we have to look at. There's assets, so down payment, there's credit, which we just spent some time talking a little bit about, and there's also income and our ability of verifying income, but our capacity for monthly payment. So as a W-2 wage earner, there's a few things we generally have to get together. A couple years tax returns, W-2s, 30 days worth of pay stubs. And then as a lender, we'll be doing a verification of employment. Usually it's written, and we'll do some type of verbal verification as well. Now, self-employed individuals, that can be a little bit more challenging in terms of the documentation you'll have to provide. Usually it's 2 years of tax returns. Business, if you're a sole proprietor, then we'll usually ask for the last 2 years tax returns, which include your Schedule C income. If you have an S Corp or C Corp or LLC, then we'll need those corporate returns. And generally there's a profit and loss statement required along with a balance sheet. And then we'll have to verify the business in some way, shape or form, business license, CPA letter. So we'll go through that as part of our underwriting process. Now, a few of the questions we get when it comes to income, in fact, I was just answering this exact question earlier today, which is, how long do I need to be on the job to be able to be qualified for a mortgage? And as lenders, we have to verify the last 2 years of history, either employment and or education. So let's say I just graduated from Arizona in the spring, and I'm getting ready to finally start my job here on January 1. And maybe I got an accounting degree. So I went to school for 4 years, got my accounting degree, and now I'm starting an accounting firm on January 1st. Even though I haven't been on the job for 2 years, my education will help support that 2-year requirement. So in that case, I would be totally eligible for financing. We just have to verify the last 2 years, even if I'm transitioning jobs. So let's say I've been on this job here just a month, but my previous job was 2 years. I still have the 2-year history, even though I've only been on my job for a month. In some cases, we can actually qualify clients with as simple as an offer letter. So if you have an executed offer letter and maybe you're getting to relocate to the Bay Area, for example, but you haven't quite started your job yet, if we do have an executed offer letter, we can utilize that verified source of income to help you in qualifying for a mortgage. We just have to make sure that you get your first paycheck before your first payment is due on your mortgage. A couple other questions that come up is around dual income. So we typically find this maybe in the healthcare industry. So if I'm working at one hospital 20 hours a week, another hospital 20 hours a week, so that gets me to my 40-hour work week. Now we can use both sources of income as long as I have been in both positions at least 2 years. Okay, so if you're trying to use dual sources of income, it always has to be 2 years. Now, if I'm on a part-time basis, I also have to show that I've been on a part-time job consistently for the last 2 years. If you are a W-2 wage earner, but let's say you have a side business, maybe you drive Uber on the weekends or whatnot, we can count the qualifying income that you have for your W-2 job. And as long as you've done the business, will be self-employed business as an Uber driver for the last 2 years, then we can count both sources of income. Okay. All right, so that is what we look for on the verification of income side and some different scenarios. Now, as lenders, we're going to take that income proof that you provided us, and then we'll look at that versus monthly obligations. And that's a calculation called debt to income ratio. So we take your pre-tax income versus your monthly expenses. And generally that maximum debt to income ratio shouldn't be any higher than 43 to 45%. Now there is ways that can go a little bit higher through an automated approval system. But generally it's, rule of thumb, it's a 43 to 45% debt to income ratio. So what's included in the calculation for debt to income ratio? Well, it usually includes your principal, interest, your taxes, property taxes, insurance on the new house, along with PMI if that's applicable, and then HOA if you're buying a condo or a townhouse. Sometimes we have them for single family residences, which is a homeowners association fees. So let's say that was $2,000 per month. And then if we have other obligations are at $750 a month, that means I have $2,750 in monthly expenditures. If I take that versus the $7,500, then I have a debt to income ratio of about 36.7%. Now, most first-time home buyers feel comfortable around 33 to 36% debt to income ratio, but every situation for each client is a little bit different. Some clients, like I met with a client earlier today, feels more comfortable around 23%. So it just depends on the scenario for each client. But ultimately, as a lender approving you, we want to make sure that we're no higher than 43 to 45%, but probably optimally for most first-time buyers is 33 to 36%. Okay, so that's debt to income ratio for your qualifying. Let's talk a little bit about down payment and really some of the sources that are allowed for down payment. So pretty simple and pretty obvious. So checking and savings account, as long as we can verify the last 2 months of statements showing your available assets, that's totally allowed. Cash deposits are not acceptable. So if you have maybe, we call it gift funds that are in cash, unfortunately we can't use those. But if we do have large deposits, we will have to paper trail those, or any type of transfers from a savings to a checking account. Retirement accounts can be used. So 401ks, 403bs, IRAs, sometimes you can do withdrawals. Of course, you'd want to talk with your tax advisor or your financial planner, make sure that doesn't create any type of tax event. And if you do plan on using those sources, generally you want either a quarterly statement or the last 2 months of statements. Now, as first-time home buyers that we're trying to save up money, and not all the time we can have enough funds saved to be able to make our home purchase happen. So gift funds from family members are allowed as well. Usually that's where a family member is transferring money to you towards your home purchase. Like we said earlier, it can't be cash deposits. But if you do decide to go that route, usually we'll have a gift letter provided to you for the donor to complete. We'll have to verify through a bank statement where that donor received that money. And then we just need to get proof of the transfer of those gift funds to you. Now, there is other ways to gift the funds to you. You can have the funds sent straight to escrow, which we're going to talk a little bit about that in just a bit as part of our 6 steps of home buying. But there's different options in terms of how the family member decides to transfer those funds to you. And it does need to be a family member that is the one that's going to be the donor for the funds. So when we look at home buying, and I know it's a challenge for most of us to save up enough money to be able to purchase, because usually you're going to need probably $20,000 to $25,000 saved for your down payment. As first-time home buyers, assistance programs can be a great resource to be able to help put home ownership that much closer to you. So we partner with Arizona Home Plus for the home buyer down payment assistance program. So we're an approved lender that can help facilitate these programs for you. And there's a couple different options with the Home Plus program. As you heard earlier, conventional loans require a minimum down payment of 3%. FHA is 3.5%. So the DPA programs, or down payment assistance programs with Arizona Home Plus, allow you to borrow up to 2 to 5% of your loan amount. And that is a forgivable loan after 36 months. And there's only certain counties that you can do the forgivable loan, but it's 2 to 5%, and interest rates will vary based upon how much you take in assistance. We're going to walk through a scenario in just a bit. There's also what we call a non-forgivable option, where you would be basically making payments when you either sell the home or if you refinance in the future. There is no interest charged to that second mortgage because it is truly a second mortgage. And it allows you to borrow 2 to 5% of your loan amount. Now, that particular non-forgivable option is just available in Maricopa County. But if you think about it, if your minimum down payment is 3% and you're able to borrow up to 5% of your loan amount, you can have your full down payment covered through the assistance program and have additional funds that can be used towards what we call as closing costs. And closing costs are usually 2 to 3% of your sales price. Let me walk you through a quick example of what that could look like. So as you heard earlier in our budget analysis, if you were to buy a house for $350,000, we kind of did the math of what it could look like renting for $1,600 a month versus buying at $350,000. So let's look at like what the cost would be involved to purchase at $350,000. So if we bought a house at that level, the minimum down payment is $10,500. Plus we have closing costs, which I said are usually like 2 to 3% of your purchase price, depending on what's negotiated with the seller. So I'm probably going to need about $17,500 to $21,000 out of pocket if I purchased at $350,000. Now, if I was able to take the same scenario, but then I was able to get assistance through Home Plus, I could then get an assistance through Home Plus anywhere between $6,800 to $17,500. So that's 2 to 5% of my purchase price. And now instead of trying to maybe scrape together $17,000 to $21,000 to put down, my out-of-pocket can drop all the way down to $3,500 to $14,000 with an assistance program. So obviously that can make things a lot more attainable. Most of our first-time home buyers have on average anywhere between $6,000 to $8,000 saved. So this makes homeownership so much more attainable for them. Now, there is some requirements with the Home Plus program. It does require a minimum credit score of a 640. That debt to income ratio that we reviewed earlier is a maximum of 50%. Which that might be a little bit challenging just from a qualifying perspective for underwriting. So I would say more closer to 45%. And that 45% holds true for manufactured homes. And if you're doing the VA, there's also a USDA option available through Home Plus. The income qualifications are based upon the applicants, not the household size. Why that's important is because the maximum income is, let's say, $112,785. If I earn $80,000 a year and my spouse earns $40,000 a year, combined, we're over the income limits. However, if I apply just in my name, we would still be within the income limits of the $112,785. Now, there is some homebuyer education required before the home is purchased, and as part of our consultation, we'll take you through that educational requirement and provide you with a link to be able to access the training. Okay, so that's the Home Plus program. Now, another great tool to help buyers, not just first-time and second-time buyers, is our medical professionals program. As you heard earlier, jumbo loans generally require 10 to 15% down. Well, with the medical professionals program, you can purchase at those higher levels with the minimum of anywhere between 3 to 5% down. What's more important for this program for our medical doctors and dentists and teaching professionals is that many of them have student loans that they come out of school with. And so in some cases with the medical professionals program, we have more flexibility around student loan payments. So like you heard earlier, there's income-based repayment amounts that we have to apply to the qualifying. In some cases, the medical professional program doesn't require us to count student loans for qualifying. And the debt to income ratio is usually 43 to 45%, which also is a little bit more flexible than jumbo loans. Jumbo loans have a hard stop number of 43% when it comes to debt to income ratio. Okay, so again, that's our medical professionals program for medical doctors, dentists, maybe you're a teaching professor, or if you're in residency. Okay, we're moving pretty good here. Let's go ahead and look at we call it the 6 steps of home buying. And like I mentioned to you earlier, we're going to kind of walk you through what it looks like to be pre-approved, and pre-approval is the output of a consultation with us. And I'm going to explain to you what a consultation looks like in just a bit, but the 6 steps of home buying is kind of your road to home ownership. A pre-approval is a document we provide to you that allows you to be able to show a seller that you're certified and qualified for your financing for a particular home. Pre-approvals are adjustable documents, so based upon what you're planning to offer for the property, as long as it's within the parameters of your qualifying, we can adjust that document to match whatever you're offering to the seller. So the first step in the 6 steps of home buying is pre-approval. Once we've kind of figured out what the right product is and we issue that pre-approval, then we move to step 2, and that's called house hunting. That's usually kind of the fun part of this whole buying process. That's where you get a chance to partner with a realtor that shows you different options that are available for you based upon your qualifying as well as kind of the location that you're looking for. As you learned earlier, realtors are paid for by the seller. So one of your kind of support team members as you're going through house hunting is a realtor. And we have preferred realtors in our network that we can introduce you to, or you can utilize your own realtor services. But that's a really important team member to help you with negotiating, offer submission, and ordering inspections on your new house. Now, if you submit an offer to a seller and the seller accepts your offer, then we move to step 3. And that's called entering escrow. That means you have a ratified agreement with a seller. And generally from that point to when you get your keys at step 6, it takes about 30 days, generally, give or take. Sometimes it could be a little bit shorter, but as a rule of thumb, it's usually about 30 days from the date that you have a ratified agreement. Now, your responsibility as a buyer will be to make, once you have an agreement with the seller, will be to make an earnest money deposit. That's a good faith deposit that is put into escrow. And usually it's like 1 to 2% of your purchase price. That shows the seller that you have a financial stake in the purchase, and that money is protected while you go through the escrow time period. Now, once you have that ratified agreement, within 72 hours, we will be connecting with you for a follow-up video call. And that allows us to kind of go through all your financing, interest rate options, payment structure, cash out of pocket, and just make sure that you have a great idea of what it looks like for your home financing. And within 24 to 48 hours from that point, then we're going to send to you initial disclosures that kind of spotlights all the items that we just reviewed during your follow-up. Now, one thing that is another kind of a sub timeline that starts as part of your escrow time period is a loan contingency. the contingency period. The contingency period allows you to do your due diligence on the property as a buyer, which includes getting the house appraised, getting your house inspected, and then getting your loan approved. Usually that contingency period is in the first 2 to 3 weeks of this escrow time period. So as I like to say with buyers, it usually is probably going to take us up to about step 5 in the process. So we're doing our due diligence between step 3 and step 5. Now, at every one of these milestones, we're going to send disclosures to you. It's going to highlight your interest rate, your payment, your out-of-pocket expense. So there's complete transparency in disclosures about what you're receiving in your home financing. Now, at step 4, as we move through the process, processing and underwriting is the administrative tasks on your loan. That'll include ordering your appraisal, verifications of employment, and we're getting everything prepped to go to the underwriting phase. And that's where we have an underwriter review your credit, your income, your assets, and just make sure everything fits the criteria for the qualifying of the loan. And once the underwriter has completed that, that will move us along to step 5, which is loan approval. And that's when that approval has been issued. And we're almost all the way through the finish line. And so at step 5, we're also going to be at the end of our contingency period. So if everything checks out from an inspection perspective, appraisal, and of course, now you'll have your loan approval, then with your realtor's help, you'll be able to sign off on your contingency. That tells the seller that everything checks out for you guys and you want to move forward in the process. The next thing that's going to happen in step 5 from a lending perspective is we're going to issue to you a final closing disclosure here. That final closing disclosure is going to, once again, highlight your interest rate, your payment, your out-of-pocket expense. You'll know all the costs again. You'll see those in a couple different iterations of disclosures, but it also gives you a 3-day cooling off period to make sure you still feel comfortable with the financing. Once that 3-day cooling off period has elapsed, then you're going to move to step 6, and that's called closing the loan. And the closing the loan happens, it's an in-person process. Everything up to that point, and from a disclosure perspective, is all done via e-signature. Of course, you can do things via wet signature, but usually it's done e-signature, all those disclosures. But when you get to step 6, the signing or the closing will be done with a public notary in person. Usually that takes about an hour or so. Once you've completed that signing, then you will be wiring the funds left for your transaction, or you can deliver a cashier's check. The escrow company will gather those funds, make sure you've contributed what you're supposed to as a buyer, and then we will wire in the funds for the mortgage. The escrow company will then balance everything, make sure everything's been set up correctly. And if everything is in line, then they're going to transfer documents to the local county recorder's office. They generally will record a grant deed that transfers ownership to you. And then they're also going to record a deed of trust. And that is the security agreement that gets recorded that indicates you're going to be repaying the loan that you've been provided. Once all that happens, we get recording confirmation back from the escrow company. And then you become the official owner of the property, and we get a chance to celebrate and do a virtual high five and really celebrate this huge accomplishment. Because like I said, this is probably going to be the biggest purchases that you make in your lifetime. So, all right, so that's the 6 steps of home buying. Now, I mentioned to you earlier, before we start on that path to home ownership with the home buying process, we really, we encourage, but we do a consultation with every client. So every client, before they're pre-approved, meets with me for a video call to build a home buying game plan. And before we get to that point, you would submit an online application, which you can see here. The online application is an intuitive process where it actually will request documents from you based upon your answers to questions in the online application. You'll then upload those items requested. And then once you've completed that, then you'll just go ahead and schedule your consultation. You can do it by phone too. We always encourage video because that allows us to be able to screen share with you and show you what different options could look like. Now, as we kind of leave from today's discussion later on, I mean, if you do have some questions that just need to get answered, maybe just want to kind of walk through your finances with me really quick and maybe talk a little bit about credit or down payment scenarios, we can always do a quick intro call, which is usually about 10 to 15 minutes for me to answer some questions out of this workshop. So highly encourage everyone to set up an intro call if you do have some of those questions. But if you're ready to jump right in and you want to kind of just figure out what a home buying game plan looks like, really encourage you to get the online application completed and then get your consultation set up on the calendar. Here's kind of the framework of the consultation. We do some goal setting, talk about affordability, kind of where you're at right now. Where do you want to go with home ownership? Talk about locations, what areas you're looking at. Obviously, that'll drive the level of sales price. I'll walk you through your application, make sure everything's all accurate. We'll talk about interest rate, closing costs, and just kind of get, like I said, a full comprehensive game plan put together. We'll even talk about the benefits of partnering with one of our realtors, preferred realtors, or connecting with a realtor on your own. And then the output of that consultation will be to have you pre-approved and start that 6 steps of home buying on your way to home ownership. Now, as being part of the University of Arizona alumni or being a staff employee, we do provide a $750 discount that you heard about earlier today. Generally, that takes the form of, we have a reduction in fees. Usually we charge a $910 processing fee as part of your closing costs. That gets dropped down to $160 with the $750 University of Arizona alumni discount. Now, if you're joining us through our other partnerships like UC Irvine, UC Davis, USC, or even UC Riverside, that same discount applies for those team members as well. And then, with our partnership with Arizona, we do have access to all the different programs that you heard this evening. And, we are a trusted mortgage advisor, not just for the Arizona Alumni Association, but several different associations, as well as state of California employees as well. And so we really value education in this home buying process. We want to really help support you and be a resource for you as you're deciding to take this pretty significant step in your financial future. And so that's why we try to provide the value with these educational sessions. Now, speaking of resources, we have our mobile app, which is right here. That's available for Android and Apple. And so you can download that right to your phone. You can even start your application process right through mobile. You can use our calculators that are available. You can upload documents. You can follow the progress of your loan all through mobile. Now, here's all my contact information. If you do have some questions as kind of a follow-up to tonight's workshop, feel free to email me, text, call, whatever's good for you. And like I said, you can always schedule an intro call using the link here. And we really encourage our attendees of our workshop, follow us on some of our social channels. We really try to share some of our testimonials of our clients, what they're saying about us on Facebook or Instagram. Check us out on Yelp or some of our Google reviews, because we want to celebrate this huge accomplishments for our graduates of our home buyer workshops. Like I said, we think this is probably going to be one of the biggest investments you're going to make in your lifetime. So we want to celebrate the accomplishment that you make. Okay. So with that said, that brings us to the end of tonight's workshop. Hopefully you got a lot of great information out of tonight's discussion. We're going to hang tight, stay online for a little bit, and answer any questions we have for the group. And I'll just check back with you as we get those questions coming in. Okay, so we just got a question that came in with regard to explaining escrow, and that's a good question. I think we probably could go a little bit further in that. And so when you purchase a home, there's the escrow time period, which is usually 30 days. There's a title and escrow company that is involved during that process. The escrow company and title company, the title side of it is for documents perfection. So making sure the grant deed gets recorded, checking the title searches, make sure there's no liens on the property, that kind of stuff. Escrow is kind of the fiduciary side of it, meaning like your deposit is held in escrow. They're gathering the funds from the lender when we wire the funds to make sure everything is accounted for. You'll hear escrow in a couple different facets. That's the title and escrow side. There's also escrow impounds. Escrow impounds are for your taxes and your insurance on your new mortgage. And we kind of explain that during your follow-up consultation.
Another question.
Yeah.
Is it possible to get approved with student loan in default and being garnished?
Okay. So a question came in, is it possible to get financing with a student loan that's in default and garnished? That depends. We'll have to kind of look at that. If they're collecting payments on that student loan it may not be showing up on the CAVERS reports. We might have eligibility there. We would have to look at that specifically to make sure that everything is okay there. But I would encourage you for that particular question, if you want to maybe take that question offline, maybe we can set up a quick intro call and I can ask some more specifics there.